Started things off a little bit different. Wanted to give a general update on interest rates. March, rates ticked up a little bit. Last couple of weeks, rates have come down, but we did see some slight improvement in interest rates. Some of that is the ceasefire stuff with the war going on in Iran. Some of that is rates maybe hit a peak a couple weeks ago as tensions escalated. But really, I think this is a testament to the rate cuts that we've seen over the last couple of years filtering through the system and helping to put a cap on how high interest rates can go. With rate cuts, I generally say Fed cutting interest rates doesn't directly correlate to lower mortgage rates, but it lowers the floor for how low interest rates can go. And also in this case, it also lowers the ceiling of how high interest rates can go. So I think that we're seeing the benefits of the rate cuts as far as rates coming back down the last couple of weeks. We'll certainly take some good news here a couple of weeks in a row. Rates move in the right direction. Went from 6.45 to 6.38 as it sat this morning. So we'll see what the day holds, but hopefully that will carry us through the week here with another positive week for rates. And then also just a quick, did you know, I'm trying to share a particular loan guideline every week that I think is useful that maybe you could use at some point in your business. The thing I wanted to point out this week is there is a May guideline for conventional loans that says that a child can purchase a home for their parent and treat it as a primary residence. If the parent's not able to work or if they don't show enough income to qualify on their own, the child can purchase a home for them, classified as a primary residence. And why that's important is 1, lower down payment requirements on a primary residence, 2, better interest rates. Just a cool guideline that we have a situation where a child rather wants to purchase a home for a parent. And a lot of people think maybe you got to buy it as a second home or investment property, but you can actually buy it as a primary residence. I wanted to share a quick little story here as far as our team putting a loan together that helped somebody this week. And I got a call on Tuesday. A gentleman was pre-approved by an online lender. We won't say who, but I got him a pre-approval. He went out, started shopping for homes, went under contract, went back to the lender, and the lender said, hey, debt to income ratio is too high. This loan's not going to work. So called me next. I wish we were the first call, but we were the second call. And took a look at everything for him. The other lender was discounting on his self-employment income. He had some income that was being claimed as other income. So that lender was not using that income for qualifying. But we asked a couple questions. Turns out the line of work that he's in, he gets tips. His CPA changed the way they file their taxes. The tips are claimed at a different spot. Long story short, we're able to use that income. Debt to income ratio works. He's on track here to get a loan. He's going to close in about 30 days. If you have somebody that's self-employed, if they're running into issues, we'd certainly love to chat with them, see if we can maybe come up with a different approach there. Wanted to chat about down payment assistance. It's one of the things we get a lot of questions about. And there's tons of different programs out there with down payment assistance. There are state-sponsored programs, local county-sponsored programs, national programs that are available. We spend most of our time with down payment assistance is the state-sponsored programs through the Florida Housing Finance Corporation. Tend to stick with those programs. 2 primary reasons. 1, most of those programs are continuously funded through the state. A lot of programs at the county level are not continuously funded. The money's here one day, it's gone the next day. So from a timing perspective, it's very difficult if funds are dwindling to be able to get somebody into those programs. Or you spend a bunch of time, they go find a house and all of a sudden the money's gone and they can't have the loan that they wanted. That's one of the primary reasons we stick to the state-sponsored programs. The other reason is there's a lot less red tape. I'll give you an example. There's a program offered through the city of Jacksonville. We signed up, we went downtown, we took the course. There's a bunch of stuff you have to submit up front to get somebody pre-approved for the program. You have to submit it to the city of Jacksonville. The way that it works is basically they have an amount that they pre-approve somebody for. It could be a payment between $1,600 and $1,800 a month. They end up with a mortgage payment of $1,500. They are not eligible for that because that's not within the range of what they were approved for. So there's quirks and nuances that you just don't have with the state-sponsored programs, which means a little bit more reliable. What you're getting can generally close those in 30 days, same time frame as you would any other loan. So those are really the 2 biggest reasons that we stay with those programs. But you can do those on conventional loans, FHA loans, VA, and USDA loans. So there's a wide range of options, loan programs you can use to get down payment assistance funds. And then second point here qualifies for down payment assistance. They define a first-time home buyer eligible for down payment assistance as someone who has not owned a primary residence in the last 3 years. Emphasis on primary. So we've had situations where somebody inherited a property. They owned a rental property at the time they closed, but it was not a primary residence. We were able to prove that. And they were still able to use down payment assistance. So it is not ownership in a property, it's ownership in a primary residence. Only exceptions are if you've got a veteran honorably discharged from service, they are exempt from the first-time homebuyer status. Certain census tract areas throughout all of the counties in Florida where basically they call them federally designated target areas. Somebody buys in one of those, they don't have to be a first-time homebuyer. So that's who would qualify for down payment assistance. And there's two different iterations of down payment assistance programs in terms of the mechanics of how they work. First and foremost, what a lot of people are familiar with are called bond programs. And a lot of people mistake all down payment assistance for bond programs. But the bond program specifically is down payment assistance money that is financed through issuing tax-exempt mortgage revenue bonds. So basically the state issues those bonds and they're tax-exempt. And when they sell those, that's where the money comes from to lend for down payment assistance. And with bond loans, because they are tax-exempt bonds, there are certain requirements that the money has to be doled out based on area median income. So lower AMI borrowers are who that's geared to. If you have too much money being given out to people that are at higher incomes, then they're no longer tax-exempt bonds. So what that means is with bond loans, you generally have a lower income limit. And the big thing is lenders have to count all household income. So if you have a husband and wife, just one of them is on the loan. If the other one has income, you have to count it into the income limits. And then also if you have, maybe you got a husband and wife on a loan, they've got an 18-year-old kid that lives with them that has a part-time job, you got to count his income too. So with the bond loans, it's a little bit more labor intensive because you really have to get into all the different income sources, deposits going into bank statements just to make sure there's no additional income that you're not accounting for. The trade-off is interest rates are generally better on the bond programs for the additional trouble of documenting household income. You're rewarded with a lower interest rate. And then the flip side of that is they're called TBA programs. TBA means to be announced. These loans work just like any normal conventional or FHA or VA loan in that once the loan closes, the Florida Housing Finance Corporation goes and places those loans in the secondary market. On these programs, income limits are higher because the funds are not issued through bonds, which is a huge benefit. The other huge benefit is you're only taking application income. If you're just using one income, you do not have to count the other person if you're not using their income or if you don't want them on the loan. Not having to calculate household income means sometimes you can move faster, have more flexibility. They both make over the income limit and you can make the loan work with just one of them, a nice alternative to be able to do the loan. The trade-off there is a lot of times the TBA programs have a little bit higher of an interest rate. And then how much assistance can buyers get? Different down payment assistance programs. The flagship program is called the Florida Assist Program. You can get $10,000 towards down payment and closing costs. There's a second program called the Homeownership Loan Program, or the HLP. You can get $12,500 towards down payment and closing costs. And then you have what they call the Plus TBA. With the Plus TBA, you can get 3, 4, or 5% of the loan amount. As the assisted amount goes up, the interest rate goes up as well. So if you go with a 3% assistance amount versus 5%, the interest rate is going to be lower on the 3%. Lastly, Hometown Heroes. Most people are familiar with that. That's a niche program within the umbrella of the Florida Housing Finance Corporation offerings. With that program, you get up to 5% of the loan amount towards down payment and closing costs. And then along with that, do the funds have to be repaid? There's a lot of different iterations of this program. One of the questions we get a lot is, do I have to repay the money? Is it forgiven at some point? Valid questions. The Florida Assist program, which is the $10,000, those funds are never forgiven. So it's a 0% interest payment deferred loan. You don't make any payments on it. It does not accrue any interest, but you do have to repay the amount whenever the time comes that you sell the property or refinance or you no longer occupy it as a primary residence. Hometown Heroes is exactly the same as Florida Assist mechanically on how it works. The HLP program, which is the $12,500 assistance, gets repaid over 30 years at 3%. So it's a second mortgage, a fully amortizing loan. That payment ends up working out to be somewhere around $70 a month, but it is something that you pay back over time. Whenever you go to sell or refinance or no longer occupy, whatever the balance is on that second mortgage, it has to be repaid at that time. And then the only one presently that is forgivable is that Plus TBA, where you get the 3, the 4, or the 5% of the loan amount. And no matter what option you go with, the lowest or the highest assistance amount, it's forgiven at 20% per year over a 5-year period. So There's no proration of that. So you have to wait till the end of year one. It goes to 80% end of year two, 60% end of year three, 40% end of year four, 20% end of year five forgiven. So that is the only program that is fully forgiven, and it's forgiven over a 5-year period. And the last thing I just wanted to touch base on here briefly is, what are the income limits? And once again, there's a lot of different iterations of these programs, but the income limits will fluctuate based on what type of loan program you're going into. And also family size is a big part of that as well. So the income limits start at about 108,000 for a family of 1 or 2 people. And then they go up as high as a little over 150. So 153,750 on some other programs, and also with families of 3 or more. So those income limits, when I first started doing these loans, were probably in the 60s and 70s. So those income limits do increase over time based on area median income going up. So it's gone from 70,000 when I first started doing these to almost 110,000, which is great news. But that's pretty much all I wanted to touch on here on down payment assistance.